G'day and welcome to this week's video. This week I've got a very boring Excel spreadsheet in front of us here, but we're going to have a bit of a look at a strategy that I've spoken about, but until now I've had trouble getting hold of or putting together a decent Excel calculator to show the advantage of ignoring our paying off our home loan, so just paying the interest only and focusing what was paid off the principal amount, so that's an after-tax principal payment, and putting that money into superannuation as a pre-tax figure. So as you can see, if we go focus now onto the screen, so in the scenario we've got here, we've got four distinct columns. The first line here is the home loan itself, and for example purposes I've put in $300,000. We can put in an interest rate of 4.5%, and you can see 4.5% over the $300,000 gives us $13,500 in interest each year. And for this example, the people are paying $24,440. So we can see what happens over the years, that get to around year 18 and the loan will be paid off in full between 18 and 19 years. So as an alternative, one option I'm suggesting for people that pretty well at age probably 40 and over, it's a different strategy to focus on superannuation rather than the home loan, and it's the tax difference between the two. So the four other columns we have here are marginal tax rate at including Medicare 21%, 34.5%, 39%, and the top marginal tax rate at 49%. So depending where you're placed, obviously the outcome, because this is such a tax driven strategy, the outcomes are quite differently. But let's say most people land between $37,000 per year and $80,000. That will put you into the 34.5% marginal tax rate, and let's assume that in the blue here that you earn 6% on your superannuation assets. So if we look back down the columns here, here's the loan amount. So I won't go through in depth, but in year 16 you will be approximately $116,000 better off than if you were just slugging away and paying off the principal of the home loan. And the key difference here is that any money that's salary sacrificed into your superannuation is taxed at 15%, in preference to taxed at your marginal tax rate of 34%. So it's nearly 20% saving each year by implementing this strategy, and that 20% is actually going in and earning the 6%. Obviously we can play with these figures to give the outcome that we like, but you'll just notice the box down the bottom here that someone that's on the 34.5% to break even at 4.85% on your home loan, so home loan interest rate there on the left, marginal tax rate here, you only need to break even, you only need to get 1.6%. So very strong, powerful strategy. Some of the risks with it are that we could see the government change legislation, because the idea would be that you get to your retirement age and you take out a lump sum and just pay the home loan off in full once you're retired. Imagine if the legislation changed and they didn't allow you to take lump sums and just they had to be a pension payment. So there's some of the risks that sit with superannuation's legislative change. So anyhow, I've got a really good calculator here, so clients that are interested to have a look at this, give us a yell. Happy to sit down with you and go through it. And thank you very much for listening. Please give us a thumbs up if you like the video. For those that haven't subscribed, you can please do that. That'll be great. And you'll notice in the description below us here, there's other resources you can subscribe to learn more about what we do, particularly in the areas of self-managed superannuation funds. So please feel free. They're all free education resources for you to learn more. Thanks for listening, and we'll see you next week.